Roth conversions are often framed as a no-brainer retirement strategy. And while they can be a powerful tax tool, they are not always the right move. Hi, my name is Mike Heatwall, and I'm the founder and CEO of the Dollar Group, a wealth management firm focused on helping retirees. In this video, I'll walk through some of the downsides and risks of Roth conversions, and when we might recommend holding off. First, if your income in retirement is already low, you might not owe much in taxes at all. In that case, converting may not save you anything, and could actually increase your tax bill. We've seen cases where someone is living off Social Security and a little bit of investment income, so they are already in the 0% to 10% effective tax range. For that individual, a Roth conversion might not offer much benefit. In fact, it could unnecessarily trigger taxes or increase costs without enough long-term upside. Next, Roth conversions are best for long-term planning, not short-term spending. If you convert money and then withdraw it within 5 years, you could face taxes and penalties on the earnings, depending on your age and your situation. So, if you need the money soon for a large purchase or living expenses, converting it today might backfire. Roth conversions should ideally have at least a 5-year runway before you touch them. Now, here's another important one. If you plan to leave your IRA to a qualified charity, converting to Roth likely doesn't make sense. Why? Because charities don't pay income tax. If you leave a traditional IRA to a charity, they'll receive the full amount, no taxes owed. But if you convert that IRA first, you'll pay tax on the conversion, and the charity doesn't benefit from that. So, if charitable giving is a big part of your estate plan, we may want to preserve some pre-tax IRA dollars for that purpose. Next, let's turn to the role Roth conversions can play for an individual. Sometimes a Roth conversion can create unintended consequences even if the tax rate looks reasonable. For example, it might bump you into a higher Medicare IRMA bracket and therefore increase your Medicare premiums. It might cause more of your Social Security to be taxed. Or it might affect local tax benefits like property tax exemptions based on income. So, even if the federal tax looks manageable, we have to consider the ripple effects on your entire financial picture. Now, let's look at a few different examples to ensure this all makes sense. Linda is 75 years old with an IRA balance of $300,000. She receives $18,000 in Social Security income and earns $5,000 of interest on her money market accounts. Her current effective tax rate is 0%. Linda is in a very low tax bracket. Her income is below the standard deduction, so she isn't paying federal income taxes. She asked if a Roth conversion would be a good idea. But here's the problem. There's no tax benefit to converting. Converting any part of her IRA would trigger taxes she doesn't currently owe. We recommended leaving the funds in her traditional IRA and taking only the required minimum distributions. Now for our next example, we have Rick and Sharon. They are married and both 68 years old. They have IRA balances of $1.5 million and a brokerage account with $700,000. Their income is $60,000 in Social Security, $80,000 in pension, and $30,000 in dividends and interest from their brokerage. They asked if their current plan to convert $100,000 to a Roth IRA this year was the right move. Now, at first glance, converting $100,000 from their IRA to Roth looked like a smart move. They were just below the top of the 22% bracket. But when we ran the full projection, here's what we found. The extra income pushed them into the 24% federal tax bracket and subjected them to an extra $1,000 per year each in Medicare premium increases. Instead, we recommended converting a smaller amount while keeping their income under the Medicare premium increase threshold. So, what's the takeaway from this example? Roth conversions don't just affect federal income taxes. They ripple through Medicare, capital gains, and Social Security taxation too. Next, we have Samuel and Anita, who are both in their early 80s. They have a combined $2.2 million in their IRAs. They have a modest brokerage account and home value. Their goal is to leave their IRA to their church. Their kids are financially secure, and their plan is to leave all of this IRA to the charity. They asked if it made sense to convert a portion to Roth. But here's the thing. Charities do not pay income tax, so leaving them a traditional IRA is 100% tax efficient. If they converted first, they would owe the taxes, and the charity would potentially get less because of the tax payments. Instead, we would recommend that they set up charitable beneficiary designations and discuss using qualified charitable distributions, QCDs, to reduce RMDs during their life. When we say every case is unique, we mean it. That's why we don't treat Roth conversions as one size fits all. We model the potential benefits and the downsides year by year and client by client. If you found this information helpful, please give us a thumbs up and subscribe for more financial insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwall, founder and CEO of the Dalla Group. If you are interested in seeing how we help our clients, visit us at www.thedallagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.